Viewers, and welcome to this week's video. My name is Shannon Rivkin, and this week's video I'll be discussing the CBA result and my view on both the CBA and the banking sector. And this is all obviously in light of some huge dividends and buybacks being announced by the sector, which, despite lockdowns affecting 16 million Australians at the moment, kind of seem counterintuitive, but we'll get into that now. So this is the CBA price since beginning of 2020. Strong gains earlier in the year, then COVID hit, and we saw this extreme reaction as the market understandably reacted to what this could mean for both the local economy and, of course, customers of CBA who were at this point going through massive financial distress, deferring loan repayments, and of course without any real knowledge about how the pandemic was going to go. Then towards the end of the year, once we started to get some results from clinical trials of the successful vaccines, started these big gains, back to square one on the beginning of the year. Right towards the end of the year. So by the end of 12 months, it was almost back to where it was. And of course, since then, we've seen the entire sector go on to new highs, and CBA is now at all-time highs. A little bit of a sell-off here, but certainly in the lead up to its result and some of the other numbers provided by the other banks, it's gone on to new highs. It's been an amazing turn of events. Number one, obviously driven very much by an incredibly strong housing market. In an environment where I think all big four banks are kind of vulnerable to market share losses over the long term, to new growing strong fintechs. A growing housing market is obviously a panacea for all of that, and they've been able to grow their loans pretty significantly, and of course, because the economy hasn't fared as badly as feared, its bad loss book has not been anywhere near as bad as feared either. So in the middle of last year, we saw significant provisions against expectations of bad debts, and effectively what we've seen is that they've had to write the value of those back because they just haven't been that bad. This is the Australian GDP numbers. Going beyond, obviously we don't have any forecasts in here, but the expectation is that beyond these short-term lockdowns, which certainly are dragging on, but as we've seen through last year, that the expectation is that once lockdowns are over, consumer spending will rebound and GDP will bounce back, and this is a really important key for the banks. One other key, which I haven't shown in a chart, of course, is the outlook for interest rates. One of the key catalysts for a rebound in that sector, of course, was the view that interest rates had likely bottomed and that we were going to see inflation start to flow into the system, which would lead to higher interest rates. That's really important for the banks because their net interest margins are so reliant on interest rates, and the lower they get, the lower their margins. So what we have seen recently, of course, is that long-term government bond yields have actually started to turn back down. Hasn't yet been reflected in the price of the banks. They're still very much pricing in my view, a kind of a perfect scenario of rebounding economy, continued strength in the property market, and rising interest rates. But at least on the interest rate part of the equation, we aren't seeing that, at least in the bond market. So almost expect one of those to turn around. Either the banks have peaked, or you start to see bond yields start to head up. I'm just looking at a few of the numbers within the most recent result that they announced, which of course came with $6.2 billion off-market buyback, and a higher dividend than the previous period, of course, which was expected. But things are going really well. We've got operating income, of course, is an FY20 had probably only 3 months of the pandemic. So other than that, 9 months of that was a solid year. And of course, for the most part, we've had a year that was completely pandemic affected, and yet we've seen operating income improve. Loan impairment expenses is what I mentioned just before. Huge difference here. Loan impairments have come right back down, suggesting that obviously, for the most part, customers are faring better than feared, and that's flowing through to there, and the cash NPAT. And again, this is a year filled with uncertainty because of the pandemic, but of course, optimism as vaccines have been announced and started to be administered. and you start to see how much that's flowed through to the businesses. Have they been able to write new loans? Business as well becoming more adventurous, and their business book has grown as well. And there's no doubt that right now things are going very well for the banks, despite what you'd think is a very tricky environment. This is the dividend flow, and you can see, of course, we had the second half dividend last financial year cut significantly, which meant that was down. That's $4.31, I should say, over there, and already back in this financial year with one half at least that had still some big concerns and some caution from the company. You've seen a much bigger second dividend, and of course, if we start to see this $2 maintained, we'll start to be very close to what the company was paying out pre-pandemic. Where to from here? I guess given the fact that CBA is at all-time highs, it was still in an environment where they're not at all-time high profits, not at all-time high dividends, and we're still seeing pressure on long-term bond yields. There's an argument to say that the banks are looking a little bit expensive at the moment. Certainly on a price earnings multiple, CBA, which is the best bank, on every metric you could possibly look at, is at all-time highs by some amount. And I think there is risk if certainly lockdowns continue, we could start to see some weakness in the banks. Or, as I mentioned, if I think the bond yields don't start to turn around and this lower interest rate environment starts to look like it's going to be set in for a lot longer, and that maybe inflation isn't the threat that some thought it may be, and it's likely to be transitory, then I think probably the peak in the banks is not far off, and I'd be careful in adding to your positions at these levels. Thank you very much for tuning in. If this video was of interest, please click like and subscribe, and I'll be back to you next week.